Last week was the worst week in the stock market for big tech companies since the COVID crash of 2020, and we can see a horrific week for semiconductors like Nvidia, down more than 13%. So in today's episode, we're going to take a look specifically at Nvidia, understand why this massive drop, in fact just Friday alone down 10%, whether it's something to worry about, whether or not in actual fact it does look to be undervalued. Straight away we can see Wall Street do give it a strong buy rating. So we want to run through this company. We will refresh ourselves on the health of this company, as well as seeing as now what are insiders doing, what are the institutions doing, and also remind ourselves of how strong a company Nvidia is. And also we want to talk about their outlook for FY 2025, and we can kind of get a sense of how they are going to perform based on Taiwan Semiconductors, who did give us a little sneak peek of how Nvidia are going to perform in their latest earnings. And what we're also going to do in today's episode is not just get to our intrinsic value of Nvidia, but we want to run through how we get to this number, and we're going to look at 3 different growth rates so you can see what you would maybe believe this company to be valued based on the different growth rates looking forwards. So let's start off firstly with why there was a massive crash, and we can see here that the US stock market suffer their overall worst run since October 2022. Now the technology specific sector was the worst run in fact since COVID crash. So overall the market isn't looking too great, and we can see that. Now let's take a quick look at the reasons exactly why this may have happened and what we can expect for the next week. So a few things that we do need to discuss. Firstly, we can see investors are a little bit worried about the US Federal Reserve. The reason for this, and we've talked about this a lot over the last few weeks, there may just be 1 quarter point cut interest rate this year, and there are some that are believing that maybe 2024 we will see 0 rate cuts. The other thing to consider is the rising tensions in the Middle East. We have the retaliatory strikes between both Iran and Israel, which is giving a lot of anxiety to investors, which is stopping this market from continuing its very strong run in FY24. But what we are seeing is, in fact, analysts don't believe that any of these reasons are that for the major sell-off that we saw on Friday alone, and they do see this as being essentially driven by investors who are repositioning their portfolios, as there is a massive run of big tech earnings next week that we will cover on this channel. Now, when we do look at the calendar next week, we can see a lot of big companies in the tech sector that are reporting. And as always, if you are subscribed to this channel, we will be taking a look at each one of these earnings to discuss our thoughts as and when they are released. On top of that, not just Nvidia as we mentioned, but also Supermicro Computers had an incredibly poor day. They were down 23%. And this is essentially a worry given the fact, as we can see, they broke away from when they were typically expecting to announce their earnings. So that has spooked investors massively. They are worried that essentially with their earnings, it is going to be lower than analyst expectations, which may in fact plunge the market further. Now, when we take a specific look at Supermicro Computers, they were down just 23% yesterday, or in fact Friday, depending when you are watching this. You can see it is still in the midpoint of the 52-week range. So something to consider with a lot of earnings that are going to be taking place, and essentially the market and analysts who are getting very spooked and worried with this upcoming analyst expectations. Now, if you did watch our episode when we did run through the Taiwan Semiconductor earnings, this may not be news to you, but for those that did, this is some important points that will affect Nvidia. Firstly, they beat both revenue and their profit expectations for their first quarter, and they put a lot of this on this strong AI chip demand. Now, why is that important to Nvidia, you may be asking? Well, Taiwan Semiconductor Manufacturing are the world's largest producers of advanced processors, and essentially their top clients are Nvidia and Apple. So if they are saying that a strong demand for these chips is essentially helping their business grow, then it means that Nvidia and the likes of Apple are buying this because they also have their own demand from their own customers. So this can be seen as a positive sign for Nvidia. Now let's take an actual look at the company. As we can see, over the last 12 months, they are up an incredible 173%. Year to date, still even after the drop, up 54%. But as we can see, down 10% on Friday, and over the last week, down pretty much that 15%. Again, over the last 10 years though, this is a phenomenal company, up nearly 18,000%, and we can see that drop has made barely a dent in that very impressive run. Now, they are trading towards the mid to upper end of the 52-week range. Their yield, very minimal, 0.02%. We can look at that a bit later. And the forward P is sitting at 31. As we mentioned, Wall Street do still consider this a very strong buy. Now, very quickly, we just want to show you that in terms of their top line revenue growth, they have seen some astronomical growth. In fact, under 5 billion in January 2015, 61 billion in January 24. And when we look at the graph, this is a company with some very, very strong growth to their top line. Although we do note the majority of this is just over the last few years, when we have seen AI become a lot more prominent in the discussions in the market and the analysts, and more of a need of these products. In terms of the bottom line, it follows suit as well, 631 million to just under 30 billion. And again, we can see it has really taken off over the last few years. Now, what I always like to do very quickly, we always like to update ourselves on the health of this company, their total cash versus their total debt. 4.6 billion going to 26 billion. So their cash balance is increasing over the longer term. And what we like to do with that 26 billion is compare it both numerically and directionally to their total debt, just to give us a quick look of the health. And we can see, even though it has increased from 1.4 billion to 11 billion, we note that exactly their cash is more than enough to pay off all of it, even though we do see it rising over the period. So no worries with the health of this company either. And what we want to do very quickly, look at some of their underlying metrics. The first one, growth. Now, they get an A+ pretty much across the board, which is very strong, the highest grade obtainable. Year-on-year growth, we're talking 126%, with the median in the sector of the industry leaders, 4%. We're looking on a forward basis, they're expecting over 71%. Others are expecting around 7%, and we can see the same across the board on their earnings per share year-on-year increase of 35%. Across the board, just some very strong metrics. The same can be said as well when we look at their profitability. Again, an A+ rating, the highest score they can obtain. When we look at the EBIT margin, 54%, above the industry, around 4.86. Again, gross profit as well, very, very strong. And their bottom line, 49%, is incredible, especially when you factor in that the sector median sits at 2.7%. So lots to like about this company. And what we always like to do is just compare how they've performed versus others in the industry, as we can see here. We have a lot of well-known companies, as we mentioned earlier, Taiwan Semiconductor, Broadcom, AMD, Qualcomm, Intel. And over the last year, again, no surprises, Nvidia has been the best performing, up 173%. Over the last 5 years, again, incredible performance. And over the last 10 years, no company can come near it whatsoever. But what I would say, do bear in mind that just because they've performed incredibly over the last 10 years, it doesn't necessarily mean they will repeat that, as past performance is never an indicator of future performance. Now, in terms of insider ownership, it is quite a fair amount compared to other companies we analyze, around 4%. We've noticed 9 different insiders over the last 12 months sell 347 million worth of shares. In fact, every single quarter we can see pretty much for the last few years an insider has been selling. And notably, over the last few weeks, in fact, we have Mark A. Stevens, a director, sell on 2 different occasions. We have the end of March as well as the beginning of April. A number of shares, in fact, signaling, around $30 million for him. It's difficult to say if this is necessarily a bearish signal. We do see he has sold when the price was much higher, but we also don't know the reasons why he sold, personal or financial. We typically like to look for buy signals, as that does effectively give us a bullish signal, because there's only one reason why insiders buy. That is because they believe the share price will go up. Now, institutional ownership sits around 65%. We see 47.5 billion worth of sales, with a lot more worth of buys with these institutions. What I quite like to see is the more recent quarter, Q1 of 2024, a lot more buying than selling. So not just over the last 12 months, but also, as we can clearly see in the more recent quarter, Q1 of 2024, institutions have been buying a lot of shares of Nvidia. Now, what we like to do before we jump into the metrics as well as just touch on their dividend safety, what we've seen from their latest investor presentation, they are growing across the board, not just free cash flow, which for me is a very important metric. We do see inconsistencies, but just that growth over into the last year has been very, very strong. They are also doing a lot of share repurchases, which is also nice. Remember, that does essentially give excess cash to investors, essentially increasing the portion of a company that you hold. And we can, in fact, see, as we mentioned earlier, their revenue not only increasing, and this is very, very important to note, but they are also increasing their gross profit margin over the longer term. 34% in FY20, FY24, 61%. Now, what's very nice to note from this, not just revenue increasing and the margin, but when we do come to look at their forward guidance, we will see increases as well. Finally, we can see their data center element of their revenue in FY21 has increased over the last few years to 78% as we see that need for AI increase further and further year on year. Now, finally, just wanted to point out that when we take a look at their forward guidance, they are expecting their revenue for the first quarter of FY25 to be 24 billion. Now, just to put that into comparative, we can see in their latest quarter, they did have around 22 million. So what is very typical with Nvidia is every quarter they somehow manage to increase their top line, and it is expected based on their guidance for them to increase. On top of that, which is very important, they are expecting gross margin of between 76.3 to 77%. And as we can see, that is even higher than FY24, which was a massive jump from FY23. So lots of things to know here, lots of positives to take, but as always, important is not just the essential company, but also the valuation, which we will touch on very soon. Also, just to let you know, we have released our latest free weekly article. We do run in this article essentially where we get all of our resources from that we take a look at in our episodes on a day-to-day basis. But the beautiful thing is you also get instant access free as well to all of our other articles, so do click on that pinned comment below. Now, let's take a look at their metrics. Firstly, we will just touch upon their dividend safety as they do pay a dividend to be transparent and consistent with our other episodes. 89 score, very safe. Market cap now under 2 trillion after the drop last week, but they are still a mega cap company. Last recession, well, they didn't pay a dividend, so no comparative data, but their sales was negative 35%, well below the average of the S&P at negative 12, and they also massively trailed the S&P negative 78 when the S&P was bringing in negative 55. Dividend growth, well, this isn't essentially a company that you get for the dividends. They haven't increased it since 2018, 1% on average over the last 5 years and 8% over the last 10 years, and they have effectively been paying a dividend for the last 11 years without a reduction. Now, dividend yield theory typically is what we look for, but in all honesty, it isn't one that is appropriate for this company. What we can take a look at, though, is the forward P, and we know over the last 5 years, their forward P has on average been 41.3, right now sitting at 31.4, and when we compare it, it is still higher than the information technology at 24.9. In terms of the free cash flow payout, again, very meaningless, but just for the consistency, it does sit currently around 1% and expected to be there next year as well. In terms of the free cash flow, now as we discussed when we took a look at their presentation, we can see that their free cash flow has increased dramatically over the last few years. But when we do take a look at this, we can see that FY25 is expected to continue to grow, in fact, more than 100% into next year. Bear this in mind when we do come and take a look at our valuation, as we will be considering the growth rates on the low, medium, and high percentage. Now, when we move on to the sales growth, very, very strong. In fact, next year they expect it to grow as well in the double digits or very high double digits. Typically, steady, moderate companies, we want 3 to 7% growth. This is a massive company growing at very large rates, as we can see nearly double digits every single year. Although we do want to point out FY23, not too long ago, they were flat. When we take a look numerically then, just another format to what we looked earlier, we draw your attention to their shares outstanding. Now, over the last 10 years, they would have diluted your position as that has increased. But two things we will say. Firstly, you wouldn't care because the share price grew astronomically. And the second thing to note is, as we ran through, they are expecting to do a lot of share buybacks over the next few quarters. So that will be nice for those investors. In terms of ROIC, return on invested capital, I personally like to see 10% or more, industry specific, 12% or higher. And what we can see, they have been increasing it over the longer term. 2024 was an incredible year. If they manage to continue like this year on year, this will be incredibly attractive for investors if you manage to get the valuation on point. When we take a look at the margins, nothing really negative to note. Lots of positives across the board, well above the minimums in the more recent years. 54% in FY24, and as we looked earlier, they are expecting to increase their margins as they go on quarter, and the free cash flow, very, very impressive, a massive jump from FY23 of 14% to 45% in 2024. Net debt to EBITDA, so this is the earnings before the interest, tax, depreciation, amortization, and this shows us two things. One, the dividend safety, which in all honesty isn't a main aspect in today's episode, and the second is the balance sheet strength. We want it below 1.5, and these are the number of years it would take them to pay off all of their debt net of cash on hand. As we ran through, it wouldn't even take them one day, not only just over the last 10 years, but also into FY25. So a very strong company when looking at it from that perspective. As always, if you enjoy the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump in today's episode. Now, what we have is the free cash flow growth year on year. Average growth sits at 94%. Now, we've gone for around 24%, a lot lower than the average, lower than what the analysts are expecting. Bear in mind, next year they are expecting 100 or over 100% growth of the free cash flow. But as always, this isn't something they are going to be able to maintain year on year. So we've gone for around 24%. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and based on this, we get an intrinsic value of $939. With the market value at $760, we do get an undervaluation signal. Now, on our videos, a lot of people do like to say that these are very high estimates, so we've actually used this as the high estimate for today's episode at 24%. So what we can move on to then is a 22%, so make it lower. What we note, if that is what you believe at 22%, it still would give you an undervaluation signal of $822. If that is still something that you believe is too high and you believe 20% is a more conservative or realistic approach, you could see that the intrinsic value would say that it is overvalued. So we have those four levels, a low, medium, and high. They would give you a different value depending on what input you would put in. As always, though, you can grab a copy of this model to get your own intrinsic value of Nvidia, of other companies in your portfolio, or those on your watch list by clicking on the pinned comment below. Now, just to run through before we take it to the next stage, for those that do believe 20% is too high and you were looking at something at 15%, this is what it would put out, an intrinsic value of around $510. And conversely, if you believe 24% is too low, at a growth rate of 30% moving forwards, it would be around 1,400, which if you have seen other episodes, that is what analysts at a higher rate are expecting. So today's episode, let's pull through a growth rate of 24%, and the intrinsic value then in today's episode is just that DCF model. As always, though, we do run through the majority of these models on each episode, but it can be different depending on the stock itself. So with this intrinsic value at $939, we always use a margin of safety of 10%, and we execute on that if it meets three golden criteria. That is a wide moat, strong financial metrics, and good forward-looking data, which you could argue for Nvidia, it does hit those three. Now, in terms of a margin of safety, we keep going till it's near the current trading price to know what it is for today's episode. And in all honesty, it isn't too far off a 20% MOS level. What I would say then in today's episode, it does sit between 15 to 20%. In terms of Wall Street and what they forecast over the next 12 months, well, they believe the share price will go up significantly to around $1,005 with upside of 32%. As we saw at the beginning of the episode, they do believe this to be a strong buy now. However, as always, do let us know your thoughts in the comments below throughout the whole episode. What did you think? Is this one you are looking to add? Maybe one you have on your watch list, or maybe you sold it a few weeks ago when it was significantly higher. This isn't one that I personally hold indirectly, though. It is one that I hold through ETFs. Directly, it isn't. But if this does start to come down and we have around a 25 MOS level, around a $700 mark, which it could happen over the next few weeks, this is one that I will probably start to add. As we can see, it is a wide moat company. It does have some strong financial metrics and some good forward-looking data. But as always, do let me know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.